Welcome to Crescat's Market Call, featuring our macro and activist mining research. I'm Kevin Smith, Crescat's founder and chief investment officer. Before we get started, please read through our important disclosures being shown now. These and additional disclosures regarding the risks involved in the type of investments we will be discussing, as well as the fund's performance, can be found on Crescat's YouTube channel or on our website using the QR codes on the slides. The type of investments discussed on these videos can carry significant risks, including risk of loss. The videos are intended to be general discussions of macro investment themes, the mining industry, and news with respect to the companies in our activist metals portfolio, and are not intended to be investment advice or an offer of investment advice or services. Crescat's managed funds only accept accredited investors, and the discussion in these videos has been prepared with that level of audience sophistication in mind. Any forward-looking statements may or may not come to fruition. If you enjoy our videos, please click on the like button and make sure you are subscribed to our YouTube channel to get notified of upcoming episodes. You can also follow Crescat Capital on X for ongoing macro research and important news updates on our activist metals positions. If you want to learn more about Crescat's investment strategies, we encourage you to reach out to our head of investor relations, Merrick Iwahashi. His contact information is on the screen now and can also be found on our website at crescat.net. Welcome, everybody. So we got another live market call today. We've got an exciting call today, a good in-depth one, because we're going to have Tony Reda, who's the CEO of Tectonic, appear in a one-on-one conversation with me for the finale here at the end. And we pre-recorded that 2 days ago, but exciting updates from Tony on Tectonic to come here at the end. What I want to do, we just put out a research letter that has a $20,000 price target for gold. And so what I'm going to do is walk through our whole case for the $20,000 price target for gold. I had some of these slides 2 weeks ago, but we really refined them as we put it into the letter. I highly encourage you to go to our website, look at our recent research letter, the $20,000 price target for gold, and let's go through it. Okay, so the world gold supply, it grows at a compound annual growth rate of just 1.5% per year. And this is why I like to say, gold is really the only authentic money out there, because its supply is highly constrained by only 4 parts per billion in the Earth's crust. And with all the work that goes into mining over long stretches of time, this is over 100 years, we are only able, the entire world is only able to produce 1.5% more gold per year. And this is why gold has been money for 5,000 years. It is still, in my opinion, the de facto global reserve currency. There are currently 7.1 billion ounces of above ground gold. Let's go on to the next. What is this above ground gold? It's represented by a 22 meter cube, and that's all the jewelry, all the bars and coins, and all the gold held by central banks. Of course, central banks own gold, and there's gold resources and reserves as well in the ground. That's represented by the blue, but overall, there's the 7.1 billion ounces of gold in that 22 meter cube. That's the above ground gold, and that's what we're talking about with that supply. We think there's a lot of value and opportunity in the resources and reserves segment of the market, and that's why we're focused there in our activist metals strategy. And we're getting the money to the companies to do the drilling, to create the new resources that will become the new reserves and the new production that goes into that 1.5% annual growth. But that's where the real value and the alpha to gold is. If you don't believe my $20,000 gold price target, I'm going to give you all the reasons for it. you can, you can still have a view of a 7,000 gold target or a 10,000 gold target, and I believe we can still deliver substantial alpha to that rising gold price through our activist metals strategy that's focused on exploration and development. But let's go on to the next. The global M2 money supply. So global M2 money supply, this is currency plus bank, checkable bank deposits, some retail money market funds, but it's all the stuff that central bankers and economists like to call money. Of course, it's fiat money. It's not gold money. It's fiat money, and it grows at a 7% compound annual growth rate. This is since 2004. This is as far back as we have data for the global M2 money supply. But you can see that it's still a pretty steady 7% growth rate. Now, 7% growth rate of money supply, 1.5% growth rate of above ground gold. That's quite a big difference. So keep that in mind. Let's go on to the next. So M2 money velocity. What is this? Well, Irving Fisher, famous economist from over 100 years ago, he came up with the Fisher equation. It says that it says that M2 equals GDP, but it really says that money supply times the velocity of money supply equals nominal GDP. And what's nominal GDP? It's a combination of real gross domestic product and inflation. Okay, so park that in the back of your mind. But the whole idea with this MV, that MV equals PY or PT, some people call it Y, some people call it T. Think of it as like T for transactions, but it's it's one identity of how money in the monetary system relates to the overall economy, the overall GDP and inflation. And just remember, the nominal GDP is a combination of real GDP plus inflation. Let's go on to the next. So this is looking at the correlation between M2 money supply in the US and CPI in the US. And we can see that, central bankers, or I think, I don't know who it was who said it, it might have been Milton Friedman, but that monetary policy works with long and variable lags. Okay, so what do they mean by that? Well, central banks can control the money supply to a large degree through money printing, through reserve creation in the banking system. M2 money supply grows through the fractional reserve banking system. So the more loans we make, the more loans banks make, the more the money supply can grow. But the money supply can also grow at the core from the central bank's own balance sheet and its own asset purchases, its own money printing, and so the level of M2, it correlates to inflation, to CPI, let's say. But what's the long and variable lag aspect? It happens with the lag, that's for sure. Back in the 1970s, this was the problem, where this whole idea that long and variable lags came into play. But if you look at it recently, what's the lag time frame? It's about 2 years. All that money printing that we had in COVID, led to significant increase in inflation with about a 2-year lag, and that's how the CPI and the M2 in the U.S. lines up here, and you can see that with M2 growing again, and looking at that 2-year lag pointing forward, it's looking like we have an CPI on the rise still ahead of us. The long and variable lags, well, let's just call it a 2-year lag, because that's how it's running right now, and we can map it out right here. Let's go on to the next. So talked about this Irving Fisher equation and M2, or money supply times velocity of money equals nominal GDP. So what's the problem in the world today? we have record global debt to GDP imbalances. All this debt is creating an unsustainable imbalance in terms of the fiscal budgets out there, and we've shown that in our prior research letter, the problem with the fiscal imbalances in the U.S. The IMF has got some great papers that show this on a global scale. Here's an IMF chart from less than a year ago, but it's showing how what global debt to GDP looks like. Public debt, that's all government debt, household debt, and non-financial corporate debt. So this is, you can see that since 1950, we've been in a rising trend of global debt to GDP. Milton Friedman used to like to say that inflation is created in Washington, and he meant by the government, by the fiscal powers that be. The Federal Reserve can help to try to contain inflation, but ultimately, we believe we're in a period of fiscal dominance, which means that the central bank has been captured by the government, and they really don't have any power to do anything except to help accommodate the enormous fiscal imbalances that we have. But what does this all mean? It means that we have an unsustainable level of global debt, and the only way that this debt can be managed is not, you can't look at debt in and of itself. You have to look at it relative to nominal GDP, and that's what this is. The only way or the path of least resistance to deleverage global debt to GDP is through inflation. It's through nominal GDP, but real growth, as the IMF had, and other economists have told us, real sustainable growth rates for the global economy are only on the order of somewhere between 2 and 3%. So what is the rest of that nominal GDP growth coming from? It's coming from inflation. And the only way to deleverage this unsustainable global debt to GDP is through inflation. And that's what we have in front of us, because it is the path of least resistance. Austerity doesn't work. It's not an option. And we're in a world of global fiat currency. So we don't have to, we're not tied to a gold standard at this time. These the big global economies of the world today, and this is part of the problem. This is part of the opportunity. Let's go on to the next, and look who's leading the game here in gold acquisition. Central banks have fiat currencies. They can print money out of thin air. They can buy global debt. They can buy their reserves in terms of other sovereign economies' debt. China can buy U.S. Treasury bonds. Japan can buy U.S. Treasury bonds. They do. They have. They can hold their central bank reserves in the form of other countries' Treasury bonds. They can also hold gold, and they do. Central banks have been net buyers of gold now since the wake of the global financial crisis. It's global central banks. It's led by China at this time, and this is the trend that we live in. When is the U.S. government going to get into this game? This is the game theory. This is the prisoner's dilemma. This is the geopolitical world that we live in today. And I believe the U.S. government is going to have to get into the game. If they don't, we can still have our $20,000 price target, and I'll show you how we get there. If the U.S. government starts to get into the game in a big way, we could see $20,000 gold a lot sooner. Let's go on to the next. So this is looking at the trend now of global M2 money supply growth. We showed that it grows at 7+%. We showed the above ground gold growing at only 1.5%. Showed that central banks own gold, fact, the global central bank gold holdings now in dollar terms have surpassed their holdings of U.S. Treasuries among foreign central banks. We are looking at this extending this trend out. It's about 4 years. If you extend the current trend out, keep in mind, I think the global M2 is about to accelerate. Well, it's already starting to accelerate, and there's a lot of channels by which we think it's going to accelerate, even if the Fed doesn't print money. We think that's through the deregulation in the banking system, particularly here in the U.S., but also globally. And but if you just project that same current trend of global M2 money supply growth to the above ground gold that only grows at 1.5%, theoretically, what we're saying here is, that this is a hypothetical price target for gold, points to $20,000 an ounce. It assumes that the total value of all the gold in the world is equivalent to the global M2 money supply at the prevailing US dollar exchange rate. It does imply a 100% backing of global M2 by the world's above ground gold supply, and its theoretical model. The accuracy of this projection is speculative and depends entirely on whether the underlying economic assumptions and forecasts prove to be correct, which may not happen. Now, why do I believe this is very likely to happen? Because of the imbalances that I showed you, and because of this game theory prisoner's dilemma that we're in, where we're in a period of geopolitical conflict and unsustainable global debt to GDP imbalances that practically can only be resolved by inflation. And it's game theory. So are you gonna want to own your geopolitical adversaries' treasury bonds? It doesn't work. I mean, look at what happened with with assets that were seized by the U.S. Treasury from Russia that were held in U.S. Treasury bonds, and that's why you have adversarial global sovereigns moving away from U.S. Treasuries and buying gold. How is the U.S. going to maintain its world reserve currency status, like it had in the up until now, and even today? How's it going to maintain that status without getting back into the game of firming up its reserves with gold? And it's a geopolitical prisoner dilemma. But let me just pause for a minute. Let's just keep going with the chart presentation, and maybe it'll come together more. So that's one pathway, a completely independent pathway to getting to a $20,000 gold price is looking at past times when we've been at record valuations for the U.S. stock market that have been followed by a substantial stock market decline and then a U.S. dollar devaluation. And those two things happened both during the Great Depression, and they happened in the 1970s. We are at even higher valuations today across a whole plethora of valuation metrics, whether it's trailing PE, forward PE, CAPE ratios, price to books, price to sales, EV to EBITDA, Tobin skew, market cap to GDP, ROE. You take a combination of all these different valuation metrics and you rank them on whatever these metrics we had going back to 1929. Some of them didn't exist back then, but a lot of them did. We had PE ratios, we had CAPE ratios. We can see that this is the most overvalued U.S. stock market that we have ever been in. Let's go on to the next. We also can see that the fundamentals are turning down for where we think the biggest bubble in the stock market is today, which is AI. And this is showing the hyperscalers forward 4-quarter free cash flow. Look at the fundamentals turning down, dramatically. This is exactly what happened in the tech bubble in the early 2000s, and it's exactly what led to the bust. We think it's going to lead to the bust here as well. The S&P still, within like 1.5–2% of record all-time highs right now, and we haven't seen anything yet. Of course, there's a big hedge fund, Leopold Aschenbrenner's hedge fund that just lost something like $25 billion. I mean, it's like a Madoff level amount of loss. You have the Kospi index in Korea down 40% or so, and margin calls and suicide rate is up dramatically. I mean, this is all unfolding really quickly here right before our eyes, and we haven't seen anything yet. The S&P 500 is still levitating. It's like Wile E. Coyotes, ran off the cliff and is still just twirling his legs here. This is the U.S. stock market that we live in today with this AI bubble. Let's go on to the next. So what's another completely different pathway to get to $20,000 gold? Well, let's look at those other two time periods. So we had the Great Depression, we had the 1929 stock market crash, and what happened in the wake of that? U.S. citizens were hoarding gold. The dollar was pegged to gold at $20.67 per ounce of gold, but it was starting to trade up to above $30 or in the high 20s, or I forget exactly what it was. But in the spot market, it was breaking the peg, kind of like we're seeing in China right now and other places where spot metals prices are higher than what you're seeing in the futures markets. People were hoarding gold. This was an opportunity for for FDR to go in and confiscate gold, and then Congress later revalued it $35 an ounce. So we had in the midst of the Great Depression, we had a gold a dollar devaluation relative to gold, and that's when what we're looking at here is the gold to S&P 500 ratio. Okay, and that ratio shot up to almost five times. Gold price versus the price of the S&P 500 index. And look at it, something similar happened again in 1971 when now we're pegged U.S. dollars, still the global. Well, now it's the Bretton Woods era, and the dollar is the global reserve currency, pegged to gold at $35 an ounce. But de Gaulle in France says, well, I'm not so comfortable with U.S. dollars here. I want the gold. And Nixon said, sorry, you can't have it. 1971, he closed the gold window. We're off the gold standard. So in 1933, FDR confiscated gold from U.S. citizens, paid them the official rate, $20.67, and then proceeded to devalue it dramatically. That's acquiring gold for the U.S. Treasury and then revaluing it. In 1971, Treasury already had the gold, but we said, no, we're keeping the gold. We're no longer pegged to the dollar at $35 an ounce. And gold became completely unhinged. Inflation became unhinged. And this ratio of gold to the S&P 500 shot up to like 7.5. Okay, so what's the pathway to gold $20,000 an ounce in the current scenario? Okay, well here we are. We're down here at record lows in the gold to S&P 500 ratio today. I showed you the reasons why we could potentially have at least a 50% stock market crash here, and I'm expecting it. I mean, I've been through, in my lifetime, I've been through at least 3 of them already. So I call it a run-of-the-mill 50% stock market correction. And what happens if we have a run-of-the-mill 50% stock market correction? Well, I made this chart when gold was when S&P was at 76.09. It's still in the similar territory. So we get down to half of that, around 3,800. You take a multiple of 5.25. What's a 5.25 multiple in a dollar devaluation? Well, that gets you to gold $20,000 an ounce, and we got much higher than 5.25 in the 1970s period. We and we got just under it in 1933. So this is where we are today, and here's a completely independent pathway to $20,000 gold. What does it require? Well, it's we're looking at 50% stock market correction, and then we're looking at a dollar devaluation situation similar to those other two periods. Now we've heard that we've heard ideas of. I had a professor from the University of Chicago that wrote a letter to Janet Yellen, and this guy is a highly regarded international finance professor. He said the U.S. Treasury should start buying gold right now, and why aren't they doing it yet? I don't know, but there's got to be a strategic element to this. And there was an idea called the Mar-a-Lago Accord that was floated around in the macro community 2 years ago. It really stems from the ideas of Treasury Secretary Scott Bessent, who talked about setting up a new Bretton Woods type system. What does that mean? Well, it means where the U.S. is still the dominant superpower and the one that provides the military security guarantees for the world. Why is a country or company the global reserve currency? Well, I mean, it goes back for centuries, whether it's Roman times or the Spanish or the Portuguese or the Dutch or the French or the UK. I mean, these things go through 100-year periods of generally or longer of a dominant global superpower that has control of the global world reserve currency. Almost all the cases until recently, it's a global reserve currency backed by gold and or silver. I mean, it's in the original Constitution of the United States. The only legal tender shall be gold or silver. Of course, we changed that. But what happens when how is this dollar devaluation accomplished? Well, if the U.S. still wants to be the global reserve currency, it's going to be likely to invite it to be this new Bretton Woods type environment that Treasury Secretary Scott Bessent is talking about, which is with our global geopolitical allies and the U.S. Being the dominant global military superpower. But we're gonna have to also have the gold to back that up. So there's some ideas floated about how to strategically accomplish that through this Mar-a-Lago Accord.
Right here we're looking at the HFR Equity Hedge Index sensitivity, which basically shows how sensitive funds are moving towards the S&P. And what we can gather from looking at this is a lot of long-short hedge funds got long all at the same time at the beginning of this month. And not just long, but they got very long. And we've had a period of volatility over the past couple of weeks. Let's go on to the next. Oh, you know what? Actually, let's go back one more, because I think I got a little carried away here. And what has happened since then is we've seen what we call degrossing, where these funds are reducing overall market exposure both on the long and short side, which can lead to these kinds of sell-offs that we've been having. And we've just introduced this whole period of volatility into the markets right now, and it can make it go choppy and sideways, but it can also potentially push us lower as these funds continue to reduce market exposure. Let's go to the next. We're looking at the momentum trades right now. The top momentum sectors that we've seen for long side have been biotech, banking, REITs, but semis. So a lot of these people in the momentum trade have just had their shirts ripped off the past 2 or 3 weeks from the pullback in semis. And again, Kevin was talking about situational awareness. They had to liquidate billions and billions and billions of assets over the past day or two. And when we have this kind of situation going, there's probably more people hiding in there. And again, it seems very, very toppy. Let's go on to the next. Speaking more towards the volatility, the COPC today, or I guess it would be yesterday, had the biggest recovery, one-day gain since 2000, up 18%. This is after it just getting whipsawed up and down, up and down. I don't think we're going to see things calm down right now. Let's go to the next. And something that we had happen, what was it? On Wednesdays, we had the FOMC meeting where rates were held steady. This is the statement that they issued. And if you look at it, it's actually, aside from the 9-3 vote part, word for word, essentially identical to the one they issued previously. And it was a lot of talk from Warsh last time. He came out very hawkish, very committed to making stable prices. And it seems like it might have been all talk, because the main question is, why didn't they hike right now? If everything he was saying was true, why are we waiting? And in the press conference, he was kind of asked that here and there, and he never really gave a straight answer. So this begins to ask, or beg the question is this Fed as hawkish as they're seeming? Again, we have the belief that, in fact, they're not. And rate hikes are very, very unlikely, again, given the fiscal deficit problems, and that we're going to be entering a period of fiscal dominance. And that's what I have.
I'm sitting down here with Tony Reda, who is CEO and co-founder of Tectonic Metals. Tectonic's a company that Crescat has been invested in for a number of years now, and it's one of our most exciting exploration stories out there, our most exciting pure gold exploration story. It is in southwestern Alaska, in a pretty exciting neighborhood, very close to Nova Gold's Donlin Creek. We actually think it's even more special than Donlin Creek, but I'll let Tony get to that. So just as a general introduction, Tony, tell us, take us back to the beginning. How did Tectonic come together, and what was the opportunity you saw early on here?
Well, first of all, thank you for the opportunity to be here today, Kevin, and thank you, Crescat, for the years of support. And I do emphasize years of support. Tectonic started, probably as an idea in 2017. A lot of the Tectonic executives or some of the board members were involved with a company called Kaminak Gold Corporation. We had discovered, advanced the Coffee Gold project, which now Tullamore, formerly known as Forte, had. It was a 5 million ounce discovery. We got close to putting that project into permitting and were acquired by Goldcorp, now Newmont, now Forte, now Tullamore. But that experience really was my university, if you will, in the mineral exploration space. Being there from day one at Kaminak before we went public, so that was 2005, all the way through to take up. But watching that project go from never been drilled before, through discovery, through resource, through PEA, feasibility, we actually were able to attract 3 very well-known mining billionaires into the stock that supported us in that endeavor. And so taking that experience and saying, okay, looking across the border to Alaska, I was always inspired by the mineral potential that jurisdiction had. It was completely what I felt underexplored, untapped, a lot of high-grade tenure, great infrastructure for a northern jurisdiction. And the other sort of icing on the cake was the ability to work directly with the native corporations in Alaska. And so that idea became a reality in 2018 when we acquired our first 2 projects. And then subsequently, a few years later, we're now looking at the Flat Gold project, which is our core asset. So Tectonic really was the brainchild that came out of those experiences at Kaminak, and the the notion of, trying to do something different in the exploration and mining space, which is what our sort of tagline, the shift in the game, is all about.
Okay. All right. Well, tell us a little bit more about the Tectonic story in terms of how it's evolved.
Well, the idea, again, to work with a native corporation transition into, applying that shift in the game mindset, where we simply ask the question, is there a better way to explore or to run a company in the mineral exploration space? We looked at the challenges not only that we faced at Kaminak, but also the challenges that junior mining companies face across our industry, and sometimes regardless of jurisdiction. And the ability to work directly or to partner up with a local native corporation in Alaska was extremely attractive and beneficial. So that idea turned into a partnership. It turned into our projects having a full-scale production agreement. As part of the acquisition, we've also formed IBA agreements, or impact benefit agreements. And then one project turned into 2 projects, turned into 5 projects that we leased from this native corporation. This native corporation has over 12.5 million acres of land in Alaska. And so we had or have access to some opportunities that possibly aren't in the public space. And that's how the Flat Gold project came to be. One thing to also mention how it's evolved is that this native corporation also became a shareholder in our company vis-a-vis several strategic investments. So we do have native or indigenous shareholders supporting our exploration efforts. And we set out the company to actually find the next gold mine, to do that in partnership with local communities, with indigenous or with natives. And that's now has come to fruition. The only piece that's missing is the gold mine piece. But we think the Flat Gold project, as it says here, is a true tier 1 mining opportunity. And we think we've uncovered possibly, this is very forward looking, but probably, we feel that has the potential to be one of the largest gold deposits in North America, which is a very bold statement, but don't take my word for it. Look at the evidence so far. We're not at the finish line, but the evidence is speaking very loudly that this is a massive, massive gold system.
Well, we certainly think so. And of course, the Doyon, the relationship with Doyon Corporation is one of the reasons that we originally got invested here as well. It certainly, to us, it really means that you have the right local community engagement, and the biggest First Nation corporation in all of Alaska on your side here. So it's that's very exciting. Can you give the audience here a sense of the scale and the of the targets here, and I know you have a great map in there that I think shows all of in your deck that shows the 6 different intrusive targets, and I think there's already 12 kilometers of strike that's been identified.
Yeah, definitely. I mean, I could speak to it, and I can also point to a few images on my screen here. And so if you're looking from one end to the other, it's just over 20 kilometers in size. This is a 99,000 acre land position. What you're looking at, we'll start with the right. What you're looking at is the aerial view of the property, and those pink type lines, if you will, represent streams or creeks that have produced gold. And so you have where the eroded topography is, that also represents an intrusion or a plateau. This is a reduced intrusion related gold system. And then the left image is a geophysical image that highlights these intrusive bodies or these potential deposits. And this isn't a one deposit story. There is truly potential for 6 deposits here. And that potential has been validated because we have placer gold shedding from these plateaus. So these plateaus, the streams and creeks around them, have produced gold. I always say, especially with the reduced intrusion related gold systems, a lot of people talk about the pathfinder elements, bismuth, tellurium, tungsten. That's great. but there's no better indicator of gold than gold itself. And so this property has produced over 1.4 million ounces of recorded gold production. You can see Flat Creek, which is what our project's named after on the right, 650,000 ounces of recorded placer gold production from the 1900s right through till about 2003, which is when the last sort of placer endeavor took place here. So going back to the scale, these anomalies have been validated because there's placer gold coming out of them. They also have soil anomalies that mimic a reduced intrusion related gold system. And the third leg here is that the third leg of the stool is that every time we've drilled a blue anomaly, we've found gold. And so Chicken Mountain is 6.5 kilometers by 5.6 kilometers. 191 drill holes have gone into Chicken Mountain. Every hole has hit gold. We've only tested 3.3 kilometers of that 6.5 kilometers. So not only is the anomaly that size, but the host rock that's carrying the gold has been mapped out to almost just over 6 kilometers. And then moving north, Golden Apex, we've drilled that gram over 22 meters, validated that anomaly it only has about 4 or 5 drill holes in it. Black Creek was our most recent sort of high-grade drill hit announced earlier this year, 4.5 grams per ton gold over 50 meters. And that is 6 kilometers away from Chicken Mountain. Moving up another 6 kilometers, you have Jam and then Caribou, which is completely untested, but a dead ringer for a reduced intrusion related gold system or gold target. And I do have another image here that shows it from an oblique view. Oops, sorry, my apologies. Just go back here. You can see the sort of the breadth of the anomaly at Chicken Mountain and where the drilling is located. It's highlighted by those green dots. And you can see just even the right side of Chicken Mountain hasn't even been drill tested. And there we have that Black Creek, 4.5 grams per ton over 48 meters, 7.7 grams per ton over 25 meters. So, when I say the potential for multiple deposits, I say, look at the evidence. There's also another saying I say, which is like, in God we trust, all others must bring data. That's not my saying, by the way, but it's something that I lean into. And I say, like, let the data do the talking. Don't take my word for it. Don't take Kevin's word for it, although he's a great person to listen to. But let the data do the talking. I say this exactly to my geos as well. The evidence is speaking loudly. Go drill here. And so this is a unique opportunity. And if we peel it back, and I'll just pause after this one last point. If we peel it back to 1985, Chicken Mountain was originally optioned by a company called Fairbanks Gold, which happens to be a company that Robert Friedland started and financed. It also happens to be the company that founded and advanced the Fort Knox deposit, now mine, that Kinross owns. They drilled Chicken Mountain initially in 1985 to 89. Placer Dome, now Barrick, but Placer Dome back in the mid-'80s was drilling Black Creek. So we had multiple companies working this property. Thankfully, now we have Tectonic that has the entire land position and all of these targets to itself. It's a healthy appetite of targets, and we're up for the task and have 5 drill rigs currently on site, advancing Chicken Mountain and also Black Creek and some of these other targets.
Well, back in the 1980s, when Robert Friedland and Placer Dome were working on this property, I don't even think the reduced intrusion gold type system model had really yet been understood all that well. And now we have names like Snowline and Sitka that are proving up some big scale with these gold systems and big bulk tonnage type scale. And so what what is different today in that respect and how and why were Robert Friedland and Barrick crazy to have walked away from here?
Yeah, definitely. And, I can't speak definitively on their behalf, but, my interpretation of what transpired is that if you go back to 1985, when they made the discovery and started advancing the Fort Knox deposit, that was situated right on a highway in Alaska. And so infrastructure was really good. This area, more remote. Gold, I think at that time was probably about $200 an ounce, $250. I think it dropped down a bit as well. But the point being is that high-grade gold, I wouldn't say it was abundant, but a lot of projects, like high-grade gold back in the mid-'80s was different than high-grade gold now. So a lot of people say the easy deposits have been found, and I don't necessarily agree with that statement. But what I will say is there seem to be more high-grade deposits, and rightfully so. They've been discovered, advanced, and now become mines. So when you have a project that's on a highway like Fort Knox is, and you're having drill success there, and then at this, back in the mid-'80s, this land position was very convoluted. There was placer miners, there was land belonging to the Native Corporation, there was some state and federal land, and that's all been cleaned up. But I think that played a factor that they didn't have the entire thing. And also, the deposit model wasn't established. They were still trying to figure out what Fort Knox was. And some of the best deposits in the world, their genesis or what they actually are still debated to this day. That's a good thing in many ways. So I think that was probably and then also probably Donlin was refractory, and with $200 gold, Donlin being a refractory deposit, perhaps that also tainted themselves. Now, what I will say, in speaking to some of the people from Fairbanks Gold, I've had the opportunity to pick their brain on a few things. Almost all of them say, I always loved this project. And I think it was just, back in the mid-'80s, that was the rationale there, is that, there was higher grade gold being found elsewhere in North America or throughout the world, and probably on better infrastructure, and not fully understanding the deposit model, or how to process the low grade. Like Fort Knox didn't start out as a heap leach operation. That came, I think I might have my numbers wrong, but 10 or 8 years after they were already in production. So heap leaching and heap wasn't fully understood or done back in, it was done, but not to the extent that it is now. So I think those were some of the factors that played into why they potentially dropped the project. And that being said, this project sat dormant from 2003 till Tectonic acquired in late 2021. So what happened in that period as well? And again, it was part of the 12.5 million acres that the Native Corporation had. Donlin was refractory. This area was considered remote. Gold was 1,500, 1,800, 1,200, depending what point in time you pick. But a lot of people just kind of overlooked this entire region of Alaska, and now it's starting to get people's attention, and rightfully so.
Yeah, well, you talked about a couple of things there, and one of them was about how the infrastructure wasn't there, and now with Donlin Creek moving forward under John Paulson and Nova Gold, and that there's obviously stuff changing on the infrastructure side there that can benefit to you guys as well. I want you to talk, number one, about that, but also you also mentioned the refractory nature of the Donlin Creek deposit. I mean, it's a huge deposit. I think it's something like 40 million ounces of gold, right?
Yes.
And it's also just like 40 kilometers away, right, from Tectonic, from Flat. So differentiate for us, what this reduced intrusive style of gold and what the metallurgy work you've done so far has determined, and the potential for heap leach, et cetera. What that means versus a refractory type of deposit, and the CapEx that's going to be needed at Donlin Creek.
Okay, I mean, there's a few things to unpack there. I guess the first thing I would say is that we are 40 kilometers away from Donlin. The most recent news is actually Nova Gold and Paulson amalgamated they merged, if you will, into one entity now, i.e. Nova Gold. That just, I think, was announced last week, if I'm not mistaken. Also, as you mentioned, Donlin is 40 million ounces of gold. You heard that right, folks. 40 million ounces of gold. It will be the largest gold mine in the United States when it goes into production. So The other thing to note is that they're one permit away from being a fully permitted project. And part of that permitting was that they were able to permit this natural gas pipeline that goes from Anchorage into the Donlin area. That is fully permitted, that pipeline. It's not built, but it is permitted. So if Donlin moves forward, we will have, and move forward being into production, there'll be the pipeline for energy, there'll be improved infrastructure. And we are the next most advanced asset in the area. We have our own infrastructure, like on site. We do have, as highlighted, I'll just go to another slide here. Let me just bypass that. Sorry, maybe that's a couple slides down, but we do have an airstrip that can accommodate a Hercules plane. We do have roads on site. Sorry if I'm bypassing some of these slides here, but I just wanted to show you the picture of the infrastructure. Okay, so on site, we have a Hercules capable airstrip that can accommodate the largest cargo plane available, 48,000 pounds approximately payload. You can drive a couple of Ford F-150 pickup trucks. And to that point, Kevin, next time you come to site, we'll have the privilege of picking you up in a pickup truck or in our SUV, and we'll drive from the airstrip to our brand new camp. These are some of the infrastructure expenditures that we're making. These roads were primarily built by the placer miners back in the day. They've been upgraded to some extent. Commercial barging, as you see here in the bottom right, that's located near Donlin, so that's about 30 to 40 kilometers away, but there is a winter road that connects that barge landing site to our property. So for a heap leach or gold only type system that is free milling, we think we have the appropriate infrastructure to allow for an economic opportunity. Before we acquire a project, we do all of this analysis. We do an environmental audit, we do an infrastructure audit, we do an accessibility audit. We look at these things so we know what we're getting into. And we do believe Flat has the ability to be a standalone. That being said, you can't ignore the behemoth in the room, or the elephant in the room, called Donlin. If that thing moves forward, this whole area will benefit from a lot of infrastructure, and that will improve our economics as well. Now, the other thing to mention too about Donlin is that it is a refractory deposit. And what that means is that the gold is chemically bonded to the rock. And so what does that mean in layman's terms? Well, that means that the gold requires a lot of energy to liberate the gold from the rock. So finding gold's important, then metallurgy, and then you have your metallurgical processing, how you get the gold out of the rock. So a lot of CapEx and a lot of energy is required. Refractory deposits are somewhat abundant throughout the world, and there can be still they can be very economic. And I do believe that Donlin has that potential as well, but it does require a lot of CapEx in the billions, and energy, probably the most energy intensive projects out there. On the complete opposite side of the spectrum, opposite being CapEx, low energy, heap leach projects are the lowest CapEx typically, and 10 times lower energy required to process the gold vis-a-vis heap leach. Flat, the metallurgical testing we've done to date demonstrates a heap leach opportunity, demonstrates a free milling opportunity. So we have a completely different requirements than what Donlin would have on those two fronts. And we know a thing or two about heap leaching because the last company we were involved with, we sold that project and that company for $520 million when gold was $1,300 an ounce. And that project is now in someone else's hands, like I said, and floating a multi-billion-dollar market cap and on its way to becoming a mine. So heap leaching is a very attractive proposition for a major mining company, and also from our perspective too. There's a lot of benefits to it. So that's some of the differences between us and our neighbor Donlin. And obviously we're cheering for them and want to see them succeed. But in the same breath, we think we have something that merits a standalone as well.
Indeed. So let's focus more, since you're talking about the heap leach now, on the Chicken Mountain property and and the potential that you see there for, because that's where you've done most of the metallurgy studies so far. That's where every hole has hit gold.
Yeah.
And when you're talking about Chicken Mountain, I know, there's different investors want to see different things, and I know there's a big push by some investors to want to see that initial resource estimate and the PEA on a project. And then there's other investors, including us to some degree, who that can be okay, but we don't want to lose the momentum of the drill story and the opportunity to really grow and test the entire scope of this system through more step out drilling. How do you balance those different desires from investors, and how do you view it yourselves sitting in the CEO seat and on the board in terms of do you come out with the resource and the PEA on Chicken Mountain first, and how do you keep the rest of the world still engaged that this still has so much more room here to grow?
Yeah, it's, as my parents tell me, you're not going to make everyone happy, Tony. We put our best foot forward, and we canvass our shareholders and collect feedback, and then we let the data dictate how we want to move forward. And what we're looking at here is Chicken Mountain proper. Remember, this is only a small portion of that large 6-kilometer anomaly, or 6 kilometers of mapped host rock. So you can see here, there's those green dots and black. Green dots were from last year's drilling. The black dots are from previous years of drilling. And you can see the blue boxes highlight high-grade gold that is open. Well, first of all, I should say every hole is open, because we have 191 drill holes on this screen, and every hole has hit gold. But the blue ones were, for whatever reason, last year, it ended up being the last drill hole on a fence that seemed to have some of the better gold grades. And so if we kind of focus on the top left, if you will, that you follow that arrow down, the 2.23 grams over 41 meters, you follow that arrow down to, it was that last green dot, 4 grams over 21 in that hole. And we believe the mineralization is getting better to the east. And that's an area that we're actually drilling right now as we speak. The next green dot, or the next blue box over, there's 1.2 grams over 65 meters. And that's completely open as well. And you can see it's somewhat of an isolated drill hole. And then if you continue to go counterclockwise, say to your 9 o'clock, you have 4 grams over 30 meters, almost 9 grams over 13 meters. And it's the last drill hole on that added zone that's cross-cutting the interpreted Chicken Mountain structure there. And that theme continues with the other blue boxes, 15 grams over 22. So what we were able to do is in last year's drilling is we drilled more diamond holes, so we get better geological data, structural data, and we're taking that data and also the entire geological data set, whether it's soils, geophysics, liniment analysis, multi-element analysis, you name it. We're taking all that data and vectoring in on where the potential higher grade is in the system. And what gets me excited, it's one thing to say we have high grade potential, but when you actually see a system produce, and like in the bottom blue box there, 211 grams, and the other bottom right, 104 grams, the system has the capability to produce high grade gold. So now it's our job to find more of it. And I think this year we're gonna be successful in doing that. I think we're also going to be successful next year and subsequent years, because we're just getting more data. Somebody say, 191 drills is a lot of drill holes. But keep in mind, this is 3.3 kilometers. This isn't a 700 meter wide target or 600 or 500 meter long target. This is 3 Ks. And the host rock is 6 Ks. So going back to your question, and we look at, do we go, is now the right time to do a mineral resource estimate? Do we wait? Well, last year was not the right time. We had all this high grade still open in every which direction. So we're like, okay, let's pause, take a breath. Let's continue our exploration efforts. So this year we're going to focus on expanding that high grade, but we also see some low hanging opportunities. And I'll go to the next slide here to to highlight that, we see a low-hanging opportunity to get a mineral resource estimate published. And even just dropping the drilling down from this area down to this area here, the bottom red line, where we have deep drill holes that are intersecting or and ending in gold mineralization. So one other statistic is that 117 out of the 191 drill holes that we've drilled here, 61% of them end in gold. So when I looked at this, it's like, okay, we actually have an opportunity to put out a mineral resource estimate and still offer exploration potential, whether at Chicken Mountain or at Black Creek. What I also wanted to mention is that the mineral resource estimate that we publish is going to be a moment in time. I don't think, by no means are we at the end of finding ounces at Chicken Mountain. In fact, I think we're getting better, and it's going to continue to grow significantly. This is just going to be a moment in time. And when you have a mineral resource estimate, you can go into a different bracket of peers. You can go into the resource stage, but also what you can do is that the mineral resource estimate is the foundation for a preliminary economic assessment, or a PEA. And a PEA is your first sort of mine study, your first economic model. You can then publish that. And we think with an MRE and a PEA, we can attract a larger audience to the story. The generalists, whether in the United States or in Europe or in Asia, you can attract the broader generalists. You then meet their investment criteria. There's a lot of funds, more of the larger, more the larger sort of index type funds, if you will. They have an investment criteria or an investment committee that does not typically allow them to invest in explore codes. They need a compliant resource. They need liquidity, market cap. There's thresholds there that have to be met. So we think the PEA and MRE can provide a platform or a base to attract that larger audience. And then what we also believe is that exploration is the lifeline, not only of our industry, but also of this project. And there's not too many companies that can publish a mineral resource estimate and say, okay, this is how we're going to grow that mineral resource estimate. And then also 6 kilometers away, we have Black Creek. We have Golden Apex. And I'll just go back to those slides just to highlight, where we were just talking about or looking at and where we can potentially go. And I think I prefer this image here. So that resource that I was talking about. So when we have our mineral resource estimate and PEA published, it will predominantly be where these green dots are here. And I think we will be in an enviable position because we can attract that more, again, that generalist or that more, and that I don't want to say sophisticated fund, but the fund that needs an economic model or these investment criteria to allow for investment in our company. And we'll be in the enviable position because we can attract them, and then we can still offer exploration to our shareholders. Black Creek, 4.5 grams or 50 meters approximately, 6 kilometers away from that mineral resource estimate. How about if Tectonic could offer you 2 mineral resource estimates, 3 mineral resource estimates, or 3 deposits? And that's the vision I have in next year, is that we advance Chicken Mountain. That's going to be your sort of home base, if you will. But Black Creek, the potential there could possibly even trump Chicken Mountain. But we're going to have a drill on that. Well, we have a drill right now at Black Creek, expanding it. But how about next year, once we get our drill results, providing that this year's drill results come back favorable, that we say, okay, let's advance Chicken Mountain. Let's expand the width, the strike of it, and then potentially produce another mineral resource estimate there. And then you move over to Jam or Golden Apex, and the same thing unfolds there. There's no way, if you look at Jam, you say, okay, so Jam, by the way, is 12 kilometers away. And I'm just going to try to go to another image here if I can. There's Jam number 4. So we went in there. This target was never drilled prior to Tectonic. If you notice, Jam is 12 kilometers away from Chicken Mountain. And we were the first ones to drill this target. And you might look at that drill intercept and say, okay, not the best or sexiest drill result, but 0.59 grams per ton over 9 meters, and then There's 1.5 grams over 3. There was an 8-grammer in there as well. But from a geological or technical success, we went into a target that was never drilled before. We found gold, and we also found the pathfinder elements, the bismuth, tellurium, things of that nature, that are associated with a reduced intrusion-related gold system. To me, we did a great job, but that speaks to the fact that you can go into a target that's 3 kilometers in size and nail it on your first drill hole tells me that this thing has potential. There's no way we're that smart that we can pick that one dot. And for context, a drill hole is 3.5 inches in diameter, probably the size of this water bottle. And, take that water bottle and place it on a 3 kilometers of strike and pick the right spot, and you just happen to hit gold. So this is where I was saying, like, we have the opportunity next year and subsequent years to flush out these other targets and see if we can transform them into gold deposits or gold resources. And so the intention to produce an MRE we think that is a platform to ratchet up whether it's the value proposition. With a PEA, you can then look at metrics such as your PNAV, your CapEx to NPV. Your imagery can change because we're now allowed to talk like in a mining scoping scenario study. You can show very powerful imagery on how you're going to grow that. You attract the other type of investor. You now have metrics to use to sort of offer a value proposition, not just a drill hole. And then on top of that, like if we only had one target, I don't know if I'd go down this exact same path. The fact that we have multiple targets with drill holes, I think we can offer a multitude of things: exploration upside, discovery upside, development upside. And the other thing, the last sort of piece, is that we don't necessarily have, yes, we have Donlin next door, but we don't have a producing mine. A lot of junior mining companies that have taken the approach of just doing of not publishing a mineral resource estimate, they were typically surrounded by other producing mines that you can take sort of their feasibility study or their mine plan or their cost of things and plug them into your project. An analyst could do that and get a sense for what you have. We're in a sort of an emerging area, so we don't have the benefit. Someone can say, oh, there's a mine there. That's what the economics look like for them, or that's what energy costs or mining costs look like. We don't have that benefit. The PEA provides us an initial snapshot of what that would look like. And again, that MRE and PEA is a moment in time. The MRE, I believe, is going to continue to grow significantly, and hence the feasibility and the economics, I anticipate, will grow as well.
So you're going to keep it alive, with both a development story here potentially once you come out with the MRE and the PEA, because it does become a development stage story at that point usually. But you're going to keep alive the whole exploration story because there's just so much more exploration to be done here, and that's great to hear. So you have another slide in your deck that I think is I wanted to look at because it shows the productivity of your drilling relative to other projects out there, not other I think past producing mines or whatever it is. It really makes a good point of illustrating the opportunity here to put money to work in drilling. Can you talk more about that?
Is this the slide you're referring to?
Well, that's you could talk about that one, but I think it's this one here. Yeah, this is the one.
Yes. So just to kind of set the stage here, these are notable deposits in North America, and so we've highlighted in the sort of the box in the top left here the amount of meters that it took for them to get to 5 million ounces. Now, this is not the amount of meters it took for their first mineral resource estimate. This is how many meters did it take for them to get to 5 million ounces and greater. Another slide that would be good to create would be how many meters did it take to get to the first mineral resource estimate, and what was that initial maiden mineral resource estimate. So we have those piers there. The bottom image represents our drilled mineralized footprint. The weird shape there, that Alpha Bowl, Chicken Mountain, they're one and the same. Alpha Bowl is the extension of Chicken Mountain, but so for simplicity, we can just call it Chicken Mountain. But the drilled strike there is 3.3 kilometers. That's where one drill hole that hit versus the other drill hole, 191 drill holes in between. The width of that shape is 500 meters at its most narrow point. The widest point is 700 meters. So our mineralized footprint, as you can see, is much larger than some of these other peers. Skeena Resources, First Mining, Snowline. Doesn't necessarily mean that your mineral resource estimate is going to be bigger, but it does tell you that you're dealing with something that is larger in size. If we look at the meters it took for whether it was Great Bear with now Kinross, 850,000 meters. You look at M&I's measured and indicated, that's a resource category. Inferred is another resource category. I encourage you to add both. Technically, we're not allowed to; they have to be segregated. But you can add both, and you can get something north of, close to 7 million ounces, if you will. The Coffee Project, which is the asset that we actually discovered, advanced, and sold, 280,000 meters of drilling, and that is yielding, just under 4 million ounces. Black Pine is in the United States with Liberty Gold, 240,000 meters to get just shy of 5 million ounces. And that theme continues, but we'll focus now on First Mining, or Skeena, for example, which I just said. Sorry, Skeena is 220,000 ounces, 5.6. Again, look at their footprint. And then if you look at First Mining, 200,000 meters of drilling going into this area right here. And then Snowline, beautiful deposit, 53,000 meters going into a 700 by 400 meter area. Now, Tectonic, 23,000 meters going into 3.3K. You add this year's drilling, the 40,000 meters that we're targeting is not going to be drilled all at Chicken Mountain. But if you were just for easy math through 30,000 meters, you have 53,000 meters of drilling into that area. What this highlights is that we are still in the first innings of what this area could yield from an MRE perspective. We believe, and some of the analysts that cover us, we do believe we'll be able to get to an ounce number that would be within the range that you see of some of our peers with that amount of drilling.
Some of the analysts out there have got estimates well north of 5 million already that they think you're up to. Am I crazy?
Well, the analysts, I can't comment specifically on things, but they do have. You're right. You're not crazy. The analysts have done the modeling, and one analyst is I think in the 3.5 million ounce, and the other two are at 5 million ounces. There's still a lot of
last year's drilling.
Yes. Yeah. Based on last year's, drilling. Well, some of them one of them is based on last year. The other one is based on last year's and where they think we could potentially get to by the end of this year with the meters that we have in place. And so, again, this is just one portion of Chicken Mountain. This isn't the entire Chicken Mountain target. Remember, that's 6 kilometers. And again, why do I feel confident that the 6 case has the potential to be mineralized? A, there's placer gold coming out of the other side of the plateau, and then B, the host rock that's carrying this gold has been mapped out to that extent. And so, did Mother Nature just say only this bit? Possibly. Sometimes these faults and things of that nature, mineralization tends to be concentrated there. But I think there's very strong evidence to support that this is just a small snapshot of what is there.
All right. All right, Tony. Well, if there was one question that you wish people would ask you more often about Tectonic, what is that? That's
a good question. I think I would say there's two things that no one asks me why I'm doing what I'm doing, and then the other thing that no one asks about is actually our team. And yes, they ask about the sort of the executives or maybe the board, but there's a whole group of people. Currently up at site, I think we're at 65 people, if I'm not mistaken. And so there's people on the ground making our vision or our goal a reality. And I think when you come up to site, which I know, Kevin, you've done some site visits and you've been to, you can actually get the opportunity to meet these people that are making this a reality. And I think it's important to highlight just, who, like if I was an investor too, like, okay, who's making stuff happen on the ground there? Who's your key players? And, the opportunity to meet them and hear from them. And we're growing the team exponentially, and rightfully so. There's a need for it, but we have some really amazing people that are, whether they're, a PhD in geology, or they're great, they've managed multiple drills or operations, logistics. The whole team is rallying behind this story because they believe in the project. And I think it's important to spend a bit of time talking about them, because they actually are making this, my goal or Tectonic's goal a reality. And then the last thing, like I said, like no one asked me why I'm doing what I'm doing. And the simple answer is, for whatever reason, God blessed me with a passion for geology and exploration. And I absolutely love the challenge of finding gold or finding the next gold mine. And I also love the opportunity to connect with people. I think that's really what drives me. And, meeting, I remember it was a, I don't want to say it was a dream, but to meet Kevin or to meet Quentin, these are like, so I got to meet Rick Rule, meet all these people and then connect with them is really what feeds me. And also on the sort of more the ground floor level, meeting with the local communities or the natives or indigenous groups is extremely meaningful and rewarding. And mining or exploration is a conduit to connecting with people. And so that's that married with a passion for just give me something difficult to do and I'm all for it. And, I'm one for one, and this is, we'll see how this story plays out, but that'll be 2 for 2 if this ends up going the way I think it's going to go. And I love being the underdog and making, finding another gold mine would be, absolutely amazing.
Great. Well, the people you've put together are certainly a great team, and we're impressed with many of them. So, and I do hope to get up to site again this year and see. I mean, it looks like you're on track to do about twice as much meters as you did last year, right? Or at least.
Oh, 3, on track at least to do double. Yep. And when you're going to come to site, you're going to be like, even me, the CEO, founder, there's something really special about getting picked up in a truck from the airstrip. And, if you've been on mining sites, you get it. And then just seeing the team, the infrastructure, the drills, the fuel trucks, the excavator, the dozer, it's transformed. It's the core shack, the brand new core shack. Things like this get me all giddy, and then throw some good drill core on there. And, I'm a kid in a candy store.
So what are some of the key upcoming milestones that you think could really shift the game going forward?
Honestly, if you're not finding gold, you might as well hang up your hat. And the only way you're going to find gold is by drilling. And drill results. And to validate that even further, Kevin, you were there last year when we started putting our first drill results towards the end of August, early September. There was some really good drill results. We met at Beaver Creek, a precious metal summit there at the conference. We spoke about them, and then November. But once the flurry of assay results started coming in, I remember I was at another follow. So this is now in January of 2027. In February, a few people came up to me. It's like, can you stop with the good drill results? Because it was just like 1 week after the next, or every 2 weeks there was another banger of a hole. So that was that was phenomenal. So what's going to drive this story is that we're going to get our first set of assay results, hopefully out to the market here in August, lab dependent, of course. But once you start getting in that queue, and then it's just drill result after drill result after drill result, and that's going to continue through right to the end of the year, possibly even into January. Mineral resource estimate to follow in Q1 2027. PEA hot on the heels of that, and then we're back in the field in April drilling again. And God willing, we're advancing towards feasibility, but we have dimensions on the Black Creek discovery there. What does that look like? We have drills targeting exploration, testing, or following up on drilled Jam, Horseshoe, Caribou, Golden Apex. We can again offer both scenarios and still growing the mineral resource estimate. I remember at Kaminak, we published our first mineral resource estimate. When we published the PEA, the MRE went up, and then feasibility went up again. So, we're going to have a good, healthy discussion. You, me and the board, you and I, okay, what do we want to do with this thing? We're going to look at the drill data and say, okay, do we want to make this even bigger? And how big can it possibly be? And what a great position to be in. So that's going to be the sort of the next, 10 months here, 6 months, whatever it is, till the end of the year and into the first quarter. There's going to be no shortage of data.
News flow that's likely to come is it's going to be fantastic. I will say this is probably the most frustrating part of the season for me, kind of between May and August, where we got the news that you're starting the drill program, but we have to wait for all the drill core to get logged and sent to the labs, and then we got to wait for the labs to get their work done, and they're backed up as usual, and it's so it's frustrating, really having a strong indication that you're gonna have a lot more success like you did last year at the drill bit, and just wanting to see that, but at least twice as much drilling as last year, and a lot of potentially very good news to come. So yeah, I Tony knows that I used to try to get on him to put out more news, but I do respect that you want to let the results speak for themselves, and look at what it did last year when those results started coming in. I think that's all still right in front of us here.
Mm-hmm.
We pretty much need to wrap up here. Is there anything else you want to leave our audience with?
Well, you can definitely reach out to Tectonic with any questions or updates. We're always open and excited to interact with our shareholders or with the investment community. I would also mention, I think you can hear from Kevin. He's been under the hood of the car, if you will. He's been up to site. He's obviously looked at the drill data, and what I would say is that we don't speak with this much passion and conviction unless we truly believe that this is something special. I wouldn't dedicate my entire time, energy, and capital of this company going to a project that I didn't think it has the merits to be one of the largest gold deposits in North America. Now, that being said, I do always temper expectations, and including my own expectations. And so my parting words is just let the data do the talking. This project, the data so far is screaming that we have something significant and massive, and it's our job now to go execute and do it in a safe, responsible manner. And what you'll always get from Tectonic is honesty and integrity. And if we're acquiring a project, you can rest assured that we wouldn't be acquiring a project if we didn't think it had this sort of potential. It doesn't mean we always get it right, and so knowing when to cut the cord is important, but also knowing when to step in is just as important. And to that point, we executed the largest, or one of the largest, financings for a pre-resource company in the history of junior mining, from what I've been told. I can't validate that personally, but few bankers have told me that. So we raised $92 million without a resource, and all that was done with Crescat as I think the largest order, if I'm not mistaken, and then several other very well-known funds that are respected in the resource space. And those companies typically don't deploy capital unless they see an opportunity for something of this size and magnitude. So you can take our word for it, you can take Crescat's word for it, or you can look at our shareholder registry and look at the funds that have parked their capital in our story. And hopefully that gives you comfort to say, okay, this thing has a legitimate chance of becoming a tier 1 gold mine.
We certainly think so, Tony, and thank you so much for joining me, and good luck out there in the field. Keep up the great work.
Thank you, Kevin, for again the years of support, this opportunity to speak here today, and continuing to wave the Tectonic flag. It's not lost on us, so we're very grateful. Thank you.
All right. Take care, Tony.
Thanks.
Bye. Okay, I'm back, and I hope my mic is working. Trevor, can you just give me a thumbs up in the private chat there if it is? All right, so let's get back to where we were. I had the momentum. I got to get the momentum back. All right, so we're talking about our $20,000 price target for gold. We're talking about the gold to S&P 500 ratio, and this is the second way to get there. And a 50% stock market crash combined with the dollar devaluation relative to gold. We've seen it before. We can apply a similar math, a similar multiple, and we get to $20,000 gold. With far less of a gold to S&P ratio than we had in 1980 when gold had that move over that entire decade. We're just taking really closer to that FDR multiple, 5.25, and $20,000 gold. So we can get there. So the pathways, the timeline. Look, timeline could be anywhere from 0 to 7 years. So we have this why can it what's the 0 to 2 year timeline? Well, that's if we have a Mar-a-Lago Accord kind of a FDR or Nixon moment where the U.S. government decides to get in the game in a big way. Either through going into the market and acquiring gold directly, or through a strategic means like a Mar-a-Lago Accord type strategy with our geopolitical allies. And you look at the past history of global reserve currencies, and going back 1,000 years plus, whether it's the Greeks, the Romans, the Byzantines, or the Islamic during the Middle Ages, or Spain, or the Dutch Republic, or France, or the UK. What is the common denominator between the country that has the global reserve currency? It is the country that is the dominant global military power. Let's not forget. So what are the different timelines? There's this geopolitical game theory timeline, this prisoner's dilemma, where the U.S. government could get in the game. We could have a great reset, led by potentially Donald Trump and Scott Bessent themselves and our global allies. It could happen within a couple of years. So that's a 0 to 2 year kind of timeline potential. And could happen through gold swaps. Could happen in a strategic way with the U.S. getting back into the game. Not different from FDR or Nixon and what they did, but it would be involved with the U.S. maintaining that global strategic military power of the world. There's the geopolitical game theory around it, where are our adversaries going to get there first? Are they going to be the ones that they can print money? They can buy gold too. China's doing it. Other countries are doing it. Who's going to get there first? This is geopolitical game theory. How can it happen fast and quick? It could be just that trend line of the global M2 continuing to grow within a 0 to 4 year period. If it accelerates, it could happen sooner. But that's the kind of a 2 to 4 year time frame, is just that continued global debt to GDP deleveraging through M2 money supply growth. It could be more the 4 to 7 year path, and that's if we have this chart here, this pathway, which is the stock market, a 50% or greater stock market correction, followed by a substantial dollar devaluation and a return of the U.S. seeing gold in a strategic geopolitical manner for our own security and our own world reserve currency dominance to go along with being the military superpower. Lots of different pathways over 0 to 7 years. We could get to $20,000 gold. I've shown them all to you in this presentation here, and you can say I'm crazy, but I've shown you the math. I've shown you the different pathways. And, I'm not the only person out there with a $20,000 gold target. I think Pierre Lassonde has got a 25,000 gold target. I've heard him say recently. And, there's a billionaire in the industry who understands gold. So I don't think I'm crazy. Let's go on to the next one here. So why do we think that regardless of whether gold, goes to 7,000, 10,000, 20,000, 25,000, where is the best alpha to gold, the best outperformance relative to the price of gold opportunity in the market? We believe it is in the precious metals, exploration and development stage companies, the junior mining companies, but the ones with the premier new gold discoveries, the new big deposits, the new potential tier 1 gold mines. You just heard Tony from Tectonic talking about their flat project and their Chicken Mountain subdivision of that project, and how this could be a tier 1 global mine someday. This is where the huge alpha to gold type opportunities are in the Tectonics, the Sitkas, the El Oros. We have a whole portfolio of these guys, the Altamiras, on and on, sorry. But we'll talk about a bunch more of them in a minute. The Silverbows, we had the interview with Silverbow the other day with Travis Noggle. I mean, these are the new big gold discoveries, silver discoveries in the world that where there's just so much more appreciation potential, in our opinion, in our view, relative to the price of gold. These things are cheap. But you can do the math on this chart, which is in our letter. Go view it. I'm not going to do the math for you, but if we return to a ratio of this exploration index, the S&P TSX Venture Exchange Index, relative to the price of gold, you can see in this chart that this index, it's in the teal line in the upper panel of this chart, that there's times when it outperforms the price of gold. And it's the ratio of the two in the lower panel that you can see there. But we've been through an extraordinarily long bear market in this ratio of the exploration companies. The money has not been going into the market for mining and mining stocks. It's a huge problem, especially in this modern era with the need for defense and onshoring and electrification and all of the data centers and the AI, which is real. Even though it's a bubble, it's a real trend, and we need these resources. We need the precious and critical metals resources, and we don't have them because the money has not been going to this industry. At the same time, there's been a bear market for explorers. It went on for 12 years from that prior peak to the bottom, and the bottom of COVID in 2020. You can see in the upper panel, but the relative performance of the exploration stocks relative to gold itself, they have underperformed. Look at the periods where they outperform. Apply those same ratios to higher price targets for gold, and you can see that we get into a real bull market that trickles down, that flows down to where the new resources are that we need. We think there is an extraordinary appreciation potential ahead, and that's where the alpha to gold is with our gold target. So it's not just about the macro case for gold. It is about the macro case for gold, but it's how do we get that alpha to gold, and that's what we've been able to do here at Crescat, and I believe we're going to be able to continue to do that in a big way moving forward through some of the names that we talked about. Let's go on to the next. So this is just showing, a lot of people think, okay, we get into a bear market. Kevin, you're talking about a bear market for stocks, 50% correction. Well, isn't gold going to get, and gold stocks, aren't they going to get hammered too? Well, there's more times than not. I mean, that happened in 2008 after a huge run up in gold and gold stocks. That did happen in 2008 during that crisis, and gold stocks and gold, silver, gold stocks all came down. But that was after that, an historic run up from 2000, 2001 into the early part of 2008. we're in a completely different setup today. And this is just to show there's so many other times where you can have big corrections in the stock market and gold stocks can go up. This is looking at during the Great Depression. We're looking at Homestake Mining, the biggest mining company then. There were a lot of big mining company stocks, just like there aren't a lot of big mining company stocks today. There's only like 2 of them in the whole S&P 500, Newmont and Freeport-McMoRan. It's crazy. People just do not own mining stocks. But what happened in the Great Depression? I mean, you can see here. Look at what Homestake Mining did, and you can read the chart for yourself. You can go back and look at it in our letter, but I can't read it; it's too small here. But substantial outperformance, Homestake Mining going up at the same time as the stock market is crashing during the Great Depression. This is the same type of opportunity that's out there today. Let's go on to the next. Same thing happened in 1973, 74. What was going on then? An Arab oil embargo. I mean, similar issues in the Gulf region. And look, oil prices were going up, interest rates were going up, but guess what? The stock market went down about 50%, almost 50%, at the same time as gold mining stocks went up 376%. I mean, gold stocks can go up in the type of setup that we have today. It's no different than setup, during the Great Depression. It's no different than setup. When Nixon took us off the gold standard in 1971, we had the same type of record valuations stocks. We have the same type of record undervaluation in the gold mining stocks. This is the opportunity that's in front of us still today. Let's go on to the next. Here's another period, same thing. Well, now we're looking at that whole stretch of the 1970s, the Great Inflation, it's called, from the late 60s to up until 1980. Look at how gold stocks outperformed the S&P 500. For part of that, the S&P 500 was going down over that entire 10-year plus period. The gold stocks were up 1,292%. Versus the S&P up 41%. This is the type of opportunity. These are the comparisons that's in front of us still here today. Let's go on to the next. Here's an entirely different period, the tech bubble in the early 2000s, and look at how tech stocks plunged. We think we are in an internet bubble that is very, very, very similar to the tech bubble in 2000 when it gets going. And look how fast this Leopold Aschenbrenner's fund lost $29 billion in 1 month. This is what's in front of us, what's about to happen right now, in my opinion, in our opinion. At the same time, this was the beginning. This was the start of the gold bull market. You heard Tony talking about he's going back to, he was talking about how gold was like $200 an ounce. I mean, this is where it was in the late 2000s before it started the bull market. And this is the type of opportunity we have today. Record valuations for large cap tech stocks, record undervaluation for gold stocks. I mean, it is insane. And so here's all these different periods where gold stocks can go up at the same time as the S&P 500 goes down. This is how we're positioned at Crescat, especially in our global macro and long short hedge funds. We got both the short side and the long side. Let's keep going here. Okay, what else happened recently? What's the other, the third biggest trade that we have on in our global macro fund? I've talked about the two biggest, the long activist metals portfolio that we have in the exploration and development stage companies, but we all and the short side with the S&P 500 puts that we've got. But we're also long the Japanese yen. This is part of our dollar devaluation play, and this whole unwinding of the yen carry trade type opportunity. Look, we first wrote about the yen, our long yen position, in January with some macro charts to support that. We reiterated the trade and wrote about it in our April investor letter, and we've added to the trade, since then, and it wasn't working. It hasn't been working all year, but yesterday and today it's starting to work. Listen to Scott Besson talking about his views on the Japanese yen. He thinks it's undervalued. Hedge funds have been record short the yen as we got a short covering rally. This is one of the factors that if it really turns into an unwinding of the yen carry trade, that's all that Japanese savings money coming back and being repatriated from overseas. I mean, that what is it when the Japanese intervene to support the currency? That's what it is. They're repatriating. They're a net foreign investor in the U.S. They have a huge current account surplus. So the U.S. has a huge current account deficit, but that money can be repatriated back to Japan from the Japanese retail saver, and that is we think the yen is extraordinarily undervalued. We believe there's a big dollar devaluation. It's coming relative to gold. It's coming relative to our foreign currency trading partners, and it's the third leg of our global the third largest trade in our global macro fund. We have other trades. We're long biotech. We're long some energy, but this is probably the third biggest trade that we have at this time. I just had to point it out because it's starting to work here. We think it's only starting to work. Let's keep going. So I'm making a bold call. I believe this pullback in the metals is a time to get into Crescat's funds, our global macro, our long short fund, our precious metals funds, of course. And this is looking at our precious metals fund. Look at the alpha that we've been able to deliver. This is through June relative to all of the benchmarks, and that's through this activist exploration oriented strategy that we have. We're getting the money to the companies to create the new big tier one silver, gold, copper deposits on the planet, and we've been able to do that over the last 6 years. We have a killer portfolio, and we want to continue to do it because we think we're still early in this cycle. Let's go on to the next. But we're having a pullback, across all of our funds. We are having a pullback year to date. This is through June, and it's predominantly because the metals prices have pulled back since January and February. Both due to this hawkish Kevin Warsh, new Fed chair, and with the rising interest rates, expectations in the U.S. and the actual rising interest rates. Even though that didn't matter in the 1970s for gold, it's mattering now in people's consciousness. But we have all the reasons why it's completely unsustainable and unrealistic to really think that the Federal Reserve can be this entity that's going to be independent of the U.S. government and ensure that we go back to 2% inflation, when in fact, we believe the Federal Reserve, serves the purpose of accommodating the U.S. government, and their goal is to be able to grow the overall economy and deleverage this huge debt to GDP that we have. And there's strategic and geopolitical objectives as well that we cannot forget. So I don't think it's credible that Kevin Warsh and the Fed is going to be able to contain inflation and get it back down to 2% at all. I think it's just completely absurd, if you ask me. But this is where the consciousness of the market is, and that's why we've had this pullback in metals. Metals prices from gold from above 5,000 down to close to 4,000. I think we found the support at 4,000. In the short side of what we have going on in global macro and long short. I mean, yeah, we've seen fits and starts of it starting to work. We're heavily focused on puts on the S&P 500 because that's where the biggest asymmetry is. But the S&P 500 is still only within a couple percent of its all-time high. So even though there's some funds blowing up and losing $28 billion in 1 month, and people committing suicide in Korea because of margin calls. I mean, the signs are there, folks. But what's holding this thing up? Again, Wile E. Coyote and the Roadrunner. This is an opportunity to come in at a time where we have to set up both on the short side and on the long side for the precious metals. That's my pitch. I made a hard pitch, a year and a half ago for folks to come in on our pullback, and we ended up in the subsequent year having 5 of the top 16 performing hedge funds in the world, according to Preqin. I don't know if it's going to be as good a setup as that. I think it could be, right now, and that's why I'm pounding the table. I think it's time for investors to come in, to consider coming into our fund. So let's keep going here. I don't think I have any more slides now. We're gonna proceed with a lot of the companies in our portfolio that have had news. Because there's been so much news out there. We're gonna focus just mostly on the companies that have actually put out assay results. And so let's start with Altamira Gold. This is a project in Brazil that Crescat's invested in. We own 17.2% of this company. It is a big activist stake, and they're onto a gold porphyry discovery in the Cajueiro district of Brazil, and they have they've already had some exciting drill results. Bill Pearson, our geologist, is super excited about this one because he's the co-discoverer of Jacobina, the second largest gold mine in Brazil, and he sees a lot of similarities and opportunity here with Altamira. The recent news was results from Maria Bonita. They put out a drill hole number 39 that intersected 117 meters of 0.4 grams gold from surface in predominantly the volcanic tuffs. Drill hole 38 returned 74 meters of 0.3 gram gold. The gold mineralization in these holes, there's some other higher grade sections within those, 28 meters of 0.6, 25 of 0.5. This is gold that you heard Tony talking about, heap leachable gold. This is gold that is easily liberated from the rock, I'll use Bill's words here about these latest drill results. Significantly, drill holes MBA 36 through 39 have each intersected wide zones of gold mineralization outside the current mineral resource boundary, including 130 meters of 0.5. Hole number 38 is particularly significant at Maria Bonita because the gold mineralization occurs in the wall rock tuffs outside the intrusive, thereby expanding the exploration target. Altamira also released results of two reconnaissance holes at the Beak prospect. Those didn't come out as good, and they may have to abandon that target. But they have so many gold intrusive, gold porphyry targets on their expansive property, and the results here at Maria Bonita should not go unnoticed because this shows the potential for the expansion of Maria Bonita to the west, and it shows that there can be a lot of tonnage and easily liberated gold. This is the type of gold that can be easily heap leached, and so there's the potential for huge bulk tonnage mine, and it's in a part of the world where there's been other big gold deposits that are of the similar style of mineralization. So let's keep going here. Sitka Gold, it put out news of first let's just back up. Sitka Gold is another one of our activist positions. A lot of similarities to both Tectonic and to Snowline Gold. And one of these big intrusive gold systems. But what the news was on really of significance was not so much drill holes at Sitka, what it was that they completed the acquisition of the Victoria Gold properties. And so let me just grab this here. So Sitka announced on July 28th that they've accelerated the acquisition of their 100% interest in the Clear Creek property from the receiver of Victoria Gold Corp. So this transaction completes Sitka's acquisition of all the properties comprising the contiguous 447 square kilometer RC Gold project in the Yukon. So our RC Gold project, they have a number of these gold intrusive bodies. It's like 5 snow lines with potentially all combined, all these intrusive targets. Similar to the Tectonic story where you have 6 of these intrusive targets, and Sitka has had 6 or more of them, and they've already been drilling several of them and improving up this other intrusive gold snowline type mineralization. But the completion of this Clear Creek property acquisition is important because it gives them so much more ground in their region. It's truly a district scale opportunity here for Sitka Gold. Let's go on to the next. Aztec Minerals. Aztec put out some drill results. This is one, Crescat's got a small position here. We did give them some money to drill. It's only a 47 million Canadian market cap company, still pretty small, but I'm really impressed with the drill results that these guys have been putting out. And so is Bill Pearson, our geologist. Look at some of their top holes: 32 meters of 6.28. Gold equivalent 57 of 5.72, 36 of 5.0. These guys are in the Tombstone district of Arizona, and they have the vast majority of the whole district in their land package. But the recent holes that they put out here, they did some step out drilling, and they came back with the results from 11 RC holes, reverse circulation holes, bringing the total reported RC holes to 61 of overall 84 completed during this 25 to 26 drill program. And in addition, they reported results from their first core drilling program, but the best results came from the RC holes, and they hit another hole number 30, hit 198.1 meters, averaging 0.86 grams gold and 24.5 grams silver. So a total of 1.3 gram gold equivalent over 198 meters. I mean, this is well over a 200 gram meter hole. And these are really good results. And, that includes other intervals of higher grade within it. So their first 4 holes came back with some pumps and whistles as well, but including identifying a carbonate replacement CRD style, type style of lead and zinc within this overall property package. So this is one where we've been pleasantly surprised with the success that they've had at the drill bit, and I'm really encouraged. Let's keep going on to the next here. So Onyx Gold. Well, Onyx has a lot going on. Again, this is one where Crescat only has a small position, and this is one where I'd like to have more, frankly. But it's 102 million Canadian market cap. We do have 1.8% of the company, own 2.6 partially diluted, including warrants. But these guys are in the up in northeastern Ontario, in the Timmins Gold Camp. So famous old gold camp in Ontario, and I mean, even Quentin thought that they shouldn't be wasting their time here. The camp is mostly played out, but they have proved Quentin wrong, and I think even Quentin's become a believer here. Bill is certainly a believer, and look at some of their top holes: 69.6 meters of 3.4 grams, 28 meters of 3.5 grams, 93 meters of gram. That was, I think, before these that just came out here. And let's just see. Yeah, they released some new drill results. Hole number MC26 27A intersected. I was 3.5 grams over 28. Maybe it's pops and whistles this time around for the drill results from 17 holes. But hole number MC26324 intersected 1 gram over 93. I mean, that's a nice long intercept, including 2 grams over 20, and hole number MC26-317, 0.8 grams over 98.9 meters. So I mean, there's a couple of almost 100 gram meter holes in this result, but overall you look at their results and the size of their property package. I mean, this is a company that is starting to define a new extension of this Timmins Gold Camp, and Onyx is they control 420 square kilometers of this historic camp across a bunch of different project areas here. And another company that I'm excited that we have a stake in, and encouraged by the good results that they continue to have. Let's go on to the next. So Puma Exploration. Puma is a small company that actually has a lot going on, and they have a big property package in New Brunswick, so they have the Williams Brook project, which is option to Kinross at 65%. They've also got the McKinsey Gold project where they own 70% in northern New Brunswick, all in northern New Brunswick. If you look at this map here, I think you can see they're also involved in Canadian copper. And they actually own, I think it's like 12.5 million shares of Canadian copper, or they optioned the project to Canadian copper, I believe. And just that 12.5 million shares alone is worth something like $8 million Canadian. And this is only a 23 million market cap company, but they also put out good results on their own properties, and that's what's going on recently. The latest drill results from their Murray Brook. No, it wasn't Murray Brook here. One second. So it was from their McKinsey project. So they had an inaugural 2,700 meter drill program on their McKinsey project, and they got some decent results. Let's see, we've got whole number. Okay, let's see here. 42 grams over 42 grams over, small intercept, 0.25 meters, but that's some high grade gold. 21.86 grams over 0.3 meters, 15.5 grams over 0.3. You got these super high grade pops and whistles here. These high grade veins are reported to be located within a broader, lower grade envelope that varies in width from 5 to 20 meters. The best results were from the wider zones. The best results from these wider zones were the 0.44 over 10.9 meters, the 0.64 over 20 meters. I mean, there's some gold here, and this stuff is near surface. There's a lot going on within this little company, and it's one that we've been invested in for a while. We got 4.6% of the company, and on a partially diluted basis, including our warrants. It's only a 23 million market cap. I think there's a lot of potential to unlock some value here, and the company's got a big property package in New Brunswick. We would like to see them do more drilling. Okay, let's go on to the next. Barksdale Resources. So Barksdale, latest news really has to do with a project of theirs in Mexico, where they well, first of all, let's just back up. So Crescat has a big stake in Barksdale Resources, 16.7% of the company on a partially diluted basis. They have recently had really good results, a new copper discovery at their main project, at their Sunnyside project in southern Arizona. This news was about the news release on July 23rd was about their other property that they own in Sonora, Mexico, copper project, an IOCG copper project, so they've done some additional work here to go in and re-log some of the core, and they've re-assayed some of it, I believe. Let's see here. So that Barksdale reported on July 20th that all remaining payments to Tusk Exploration to acquire its 100% ownership in the San Javier project in Sonora, Mexico, are complete. So the company's made its final installment payment of 227,000 Canadian and issued 4.5 million Barksdale shares. All consolidated and remaining concessions, from the 2020 transaction have been acquired. They've got 100% of this project now. But what's important, and what Bill really points out as he went in and studied this, is that that the original PEA from this project was all focused on the copper, and there's actually a lot of gold here, and the current gold prices that they need to go in and update the PEA, because there's actually a lot of gold here. So Barksdale identified 5 holes drilled in 2007 that were proximal to 2021 gold-bearing holes, 4 through 5, shown in one of the figures here. But geologists collected 178 samples from the historical preserved reject samples for gold analysis, and the results show that multiple gold intercepts in 4 of the 5 2007 holes, which are in their results here in table 2. Assay results include shallow near-surface mineralization, including 6 meters of 0.345 grams gold, 18 meters of 0.5 gram gold, 9 meters of 3.4 gram gold, results consistent with the 2021 intercepts. Leapfrog resource modeling software approximates 28% increase in the volume compared to the 2021 modeled results. Deposit average grades have not been estimated at this time, but the company has engaged Antonio Loschiavo, an engineer, president of AKF Mining, to review these recent results and determine the impact of the gold resource that it could have on the current copper-only San Javier project resource base, the overall economics of this deposit. The company expects to complete an update to the copper and gold mineral resource inventory, including using current commodity price points and production costs. This evaluation may lead to an update of the PEA and possibility of pre-feasibility study evaluation. So exciting news at Barksdale's other project in Sonora, Mexico. This IOCG copper system discovery that they already have, that they've actually found gold on their copper discovery, and it looks like they're going to be further exploring that. Still, the big upside, the big excitement, and the primary upside and excitement we have with Barksdale is what's going on at their Sunnyside project, and that should not be lost either. We're excited to see more developed there, and Barksdale has completed its earn-in to get up to 67%. I think it's 67% of that project from Great Basin Metals. And so Barksdale is one where you can see, it's one of a number of companies in our portfolio that have pulled back along with the gold and the gold metals prices. It's just an example of one of many stocks that have pulled back here since this war in Iran and the hawkish new Fed. I think it's all overdone, and it's just one example of the great opportunities that exist in Crescat's portfolio to come in on this pullback, in my opinion. To come into our funds is what I'm talking about. Let's go on to the next. Kirkland Lake discovery. So Kirkland had more news, more drill results, and this is a company we only got a small stake here. We own about 1.5% of the company. This is another district, the Kirkland Lake Gold District, also in with Onyx and the Timmins District. It's also in northeastern Ontario, and this is the Abitibi Greenstone, the prolific Abitibi Greenstone belt that stretches from Quebec into Ontario, and this is Kirkland Lake is a historic gold, very highly prolific gold district. And similar to what's going on with Onyx, the guys at Kirkland Lake Discoveries are proving that there's more gold to be found in these famous districts, and they've been coming out with some great results. Recently, they put out assays from 8 additional drill holes at the Morado Gold Project, including broad near-surface mineralization, high-grade gold below the historic resource, and an extension of the North Zone. The company's also completed its first regional test of the MC Zone, approximately 500 meters west of Morado, where drilling has intersected intense hydrothermal alteration and sulfide mineralization. Assays from the MZ Zone are pending But Kirkland Lake has received a regional drilling permit also covering all of the Kirkland Lake South projects. But the highlights from the drilling, from the assays that just came back at KLM, KLM 26 hole 19 returned 0.5 grams over 91 meters, including 1.3 over 23.8 and 10.94 grams over 0.8. High grade below the historical resource at KLM 26-hole 17 returned 18.99 grams over 6.7 meters, including 125.9 grams over 1 meter. I mean, that's a pretty good hole right there. The North Expansion KLM 26-013 hole returned 0.98 grams over 35 meters. So this is, we're impressed with the drill results that Kirkland Lake Discoveries has been putting out recently, and I expect there's more good results still to come. Let's keep going. Okay, well, this was the setup for Tony's slide at Tectonic, but just to kind of we've already had the interview with Tony, but just to highlight for folks, Crescat does own 17.2% of Tectonic on a partially diluted basis. This is one of our largest positions across the firm, after San Cristobal and up there with El Oro and Sitka and Silver Bow Mining. We think this is, I encourage everyone to go look at Tectonic and listen to that interview again with Tony. This is an intrusive gold-related complex that I think has the potential to just grow, and be one of the biggest, most economic tier 1 scale gold mines in the entire U.S. That's the future, I believe, that's ahead for Tectonic, and encourage you to go check that out. So that's it for me. We encourage you to reach out to Merrick Iwahashi, our head of investor relations, if you have interest in our funds, want to learn more about them, or looking to get invested. I think the opportunity right now is incredible. We will see you in 2 more weeks. Thank you.